You are not uninsured. You are enrolled. And those are two very different things. Right now, somewhere in this country, a man is sitting in a hospital billing office staring at a number he never expected. He did everything right. He picked a plan during open enrollment. He paid every premium on time. He showed his card at the front desk. And then, months later, a statement arrived that told him his insurer had denied the claim, not because he lied, not because he missed a deadline, but because of 4 words buried on page 31 of his policy document, words that redefined what covered actually meant. That scenario is not rare. According to KFF, insurers on the ACA marketplace denied roughly 20% of all in-network claims in 2024, 1 in 5. And for out-of-network services, that number climbed to 37%. If you have employer-sponsored coverage, the denial rate among people who actually filed claims sits around 21%. Compare that to Medicare at 10%, and what you're looking at is a private market that denies claims at roughly double the rate of the public alternative. The question is not whether denials happen. They clearly do, at scale. The real question is why so many of those denials catch people completely off guard. The answer starts with a word most people skim right past: exclusion. Every policy you have ever signed contains a section called the Exclusions and Limitations Clause. Most people never read it, not because they're careless, but because the document is designed to be exhausting. A standard individual health plan runs anywhere from 80 to over 120 pages. The benefits summary is on page 3. The exclusions are scattered across pages 40 through 70. The language in the benefits section uses words like covers, includes, and provides for. The language in the exclusions section uses phrases like not medically necessary as determined by the plan, not covered when provided in conjunction with, and subject to benefit limitations as outlined in Schedule C. Those two sections are about the same policy. They are written to feel like they belong to different documents. Here is the part that tends to land hardest for people once they see it clearly. The exclusion does not have to be a flat refusal. It can be a definition. The plan may technically cover mental health services, but its internal definition of medically necessary mental health treatment may require that you have failed 2 prior treatment protocols before they approve inpatient care. The plan may cover physical therapy, but limited to 20 visits per calendar year, after which the benefit simply stops, regardless of your condition. The plan may cover surgery, but classify the anesthesia as a separate line item billed by a provider who is not in network, even when the surgeon and the hospital both are. None of those are fraud. Every one of them is in the document. This is where the phrase, covered service, becomes a trap for the unprepared. When most people hear that a service is covered, they picture the insurer paying for it. What covered actually means in policy language is that the insurer has agreed to evaluate that service under the plan's benefit terms, which then run through a secondary layer of criteria, limitations, and definitions before any payment is determined. Covered is the entry point to a process. It is not a guarantee of payment. The mechanism that sits between covered and paid is called a benefit trigger. And understanding how triggers work is the single most useful thing you can do with the next 10 minutes of your time. A benefit trigger is the condition that must be satisfied before the insurer is obligated to pay. For health insurance, common triggers include prior authorization approval, a diagnosis that matches the plan's approved diagnostic codes, a referral from a primary care physician, and documentation that the treatment was deemed medically necessary by the treating provider, and then confirmed as medically necessary by the insurer's own internal review team. That last part matters. The treating physician's judgment and the insurer's internal reviewer's judgment are not the same standard. One is clinical, the other is contractual. For disability insurance, the product that is supposed to replace your income when you cannot work, the trigger language gets even more consequential. Some policies define disability as the inability to perform the duties of your own occupation. Others define it as the inability to perform the duties of any occupation for which you are reasonably qualified by education or experience. Those two definitions, at the moment of a claim, can be the difference between a benefit that pays and one that is legally denied. Most people who bought disability coverage at work were never told which definition their policy uses. That gap between what the policy sounds like it promises and what its language actually commits to is not an accident of sloppy writing. It is the architecture of the product. The benefits page is the marketing. The definitions and exclusions section is the contract. So what do you actually do with that information? The first step is not to call your insurer. The first step is to locate the document itself. If you have employer-sponsored coverage, your plan is required by federal law to provide a summary plan description, the SPD. It is the master document, not the benefits brochure your HR department handed you during onboarding. Those two documents are not the same. The brochure describes what the plan is designed to do. The SPD describes what the plan is legally obligated to do. When those two descriptions disagree, the SPD controls. If you have an individual or marketplace plan, the equivalent document is your evidence of coverage, or EOC. Again, not the summary, the full EOC. Pull it tonight. It is available through your insurer's member portal, and if you cannot find it, you are legally entitled to request a printed copy. Once you have the document, you are looking for 3 specific sections. The first is the definitions section. Find how your plan defines medically necessary. That phrase appears in almost every benefit category, and the plan's internal definition frequently requires insurer review and approval, not just a physician's recommendation. The second section is exclusions. Read every line. You are not looking for things that seem obviously excluded. You are looking for conditions attached to things you assumed were covered. The third section is the appeals and grievance procedure. Most people skip this entirely. That is a mistake, because understanding the appeal window and the documentation requirements before you ever file a claim is the difference between a winnable dispute and a missed deadline. Here is something the denial statistics make clear that most people never act on. The appeal process works more often than people expect. Among ACA marketplace claims that were appealed internally in recent reporting years, a significant portion were overturned or resolved in the enrollee's favor. The number who actually file appeals is a small fraction of those who receive denials. Most people accept the denial as final. It is not final. It is the beginning of a documented process that the insurer is required to honor. The mechanics of a strong appeal come down to 3 things. First, get the denial reason in writing, specifically the clinical criteria or policy language the insurer cited. Second, ask your physician to submit a letter of medical necessity that directly addresses those criteria by name, not just a general statement of clinical judgment. Third, if the internal appeal fails, every ACA-compliant plan is required to offer an external independent review by a third party the insurer does not control. That external review process exists precisely because internal reviews have a structural conflict of interest. None of this requires a lawyer. It requires the document, a deadline, and the willingness to write down exactly what the insurer said and respond to it on its own terms. The broader point running underneath all of this is one that takes some time to sit with. The system is not designed to hurt you. It is designed around the assumption that most people will not read the contract, will not appeal the denial, and will not push back when the first answer is no. The financial model depends, in part, on that assumption holding. When you read the document, when you understand the trigger language, when you file the appeal with the right documentation, you are not working against the system. You are using the system the way it was legally required to function. That man sitting in the billing office at the start of this video, the one holding a denial letter he never expected, his situation is not hopeless. But the path forward requires knowing which document controls, which definition was applied, and what the appeal window actually says. Those 3 things are readable. They are available to him right now. The only thing that was missing was the knowledge that they existed and that they mattered. Pull your policy document this week, not to panic, not to cancel anything, just to know what you actually have. Because the difference between enrolled and covered is not abstract. It is written down somewhere in your plan, and now you know exactly where to look.